My name is Colette Handy. I'm a wealth strategist with Fairchoice Mortgage Company. Today, let's talk about financial literacy. We all want to succeed financially. However, in order to do so, it's important that we learn a few very important basics. Failing financially has devastating effects on us. It affects us emotionally, naturally, and that's primarily because it has such a negative effect on our families. We also know what happens when it comes to friends. Most of us know that when money is gone, friends are also gone, aren't they? Well, let's break it down. Exactly what is money? We know that money is a great universal motivator. Now, according to the dictionary, money is defined as the most commonly used medium of exchange, meaning to say, this is what we use to determine the value of the goods that we're exchanging. We know that money works much harder than people do. In addition, you know that saying that money never sleeps. We also know it never gets tired, neither does it ever get sick. Well, what is the difference between money and wealth? Very interestingly, money can be counted quite easily by looking at our bank accounts or looking at what we have in our pockets. However, wealth is a little bit different. Wealth, I would say, can be defined as money into the future because this is what determines that there'll always be money there to do the things that we would like to do into the future. Let us compare, shall we? Let's compare wealth and something called generational wealth. Again, it has to do with time. Generational wealth simply is wealth that we transfer on to the next generation. Have you ever noticed that the old family member who passed away years ago, the one that's still remembered is usually the one that left something behind? And it's usually not just his smile, is it? It has to do with leaving a legacy. Let's consider the wealth stealers. What are wealth stealers? I consider them to be items that transfer money away from our pockets to other people's. The unfortunate thing is this is usually done involuntarily and quite often without our own knowledge. Well, what are some of the wealth stealers? Taxes, a very big one, primarily because the taxes get taken off from our salary even before we actually see the money, don't we? Capital losses is another major issue. And thirdly, interest and bank charges. Interest is huge, and I want to spend a few moments on that. Let's look at the cycle of interest in our lives, because for most of us, when we start out life as a teenager or a young person, we have very little debt, don't we? However, once we've purchased our first home, we're looking at having a mortgage probably in the vicinity of $250,000. Is that the end of it? Usually not, because along with that comes several other expenses, and usually, by the time we're through, we've sold that home, purchased another, and usually it's a larger home, and by the time the second or the third, we're up to $350,000, $400,000 in debts. At that time, we start thinking, geez, it's time to start paying these mortgages down, get these debts down. By the time it's to a controllable level, we have reached very close to age 65. And what has happened to our income at that point? Quite often the income is dropped substantially. Then what do most of us do? We go to the bank and take out something called a reverse mortgage, or we get the famous line of credit. Once we do that, what has happened to our interest? Again, we're back into a cycle of paying high amounts of interest. My point simply is this. For most of us, we don't realize that we're paying interest for most of our lives, and the truth is we're actually paying compound interest, which is interest on the interest. Let's look, shall we, at the amount of income that passes through our families. In your lifetime, quite often, we don't realize how many millions of dollars are actually passing through our hands. Over a working life of 40 years, if a family is earning $50,000 combined, we're looking at $2 million passing through that family's hands. At $60,000 per year, 2.4 million will go through that household, and at 70,000, it's $2.8 million. The question is, where does all that money go to? For most of us, we really have no idea. So let's look at income allocation. We know that once we get paid, the first thing that comes out of our salary is the taxes. And taxes generally for most of us is approximately one-third of our income. Then comes the huge one, which is interest. Who knows how much that is? It depends on how much debts you have outstanding. But interest is also a major factor. And after those are gone, we're left with what's called available cash. The challenge is not so much that we don't earn sufficient money, we just don't get to keep sufficient of it. Let's look at how money flows through our life. Because for most of us, the way income is allocated is part of the problem. For most of us, money comes from our paycheck and goes into some sort of an account, usually designated by our employer. That account is usually a checking account. And how do we use the checking account? Usually the money goes in there, and from there, we take out funds as is needed to pay our bills, pay our mortgages, and available cash that we're actually going to spend. The question is, how much interest are we earning on this particular checking account? For most of us, very little. If we consider the cost of operating the account, we're probably actually earning negative interest. Simply put, our habits end up costing us money. For most of us, this is what we do. We use our checking account more or less as some sort of a slush account, meaning to say, money goes in, money goes out. Because mortgage is going to be paid next month, just let the money sit there until the mortgage payment comes out. Because of these habits, in reality, half of the money is sitting in our accounts for about half of the month. This is dramatic. Why is it so dramatic? Because let's look at an example. If half of the money is sitting in the bank for half of the month, it means to say that if you're earning $50,000 per year over a period of 40 years, which is about as long as it usually takes most of us to pay off a mortgage, at $50,000 per year, $1.5 million would have gone through our account in the fashion that I showed on the last slide. Now, one half of $1.5 million is $750,000. And one half of 30 years is 15 years. So using that previous formula, what I'm suggesting to you is that you're allowing the bank to use your money without paying any interest to you on it. Now, question is, what can you do with the interest on $750,000 for 15 years? Do you suppose it can help pay your mortgage off? I would think that it can. What does interest really cost you? In fact, when I say the word interest, what does it mean to you? For most of us, it means interest rate. And rightly so, because the rate is what determines how much your monthly payments are. However, we can be deceived by interest because rate is not the only thing that is important when it comes to interest. You see, for example, what's more important to you? The rate of interest that you're paying? Or do you think it's more important to know how much interest you're actually paying, the actual dollar figure? The latter obviously is more important, but the rate of interest can fool you quite easily. Did you know that interest is calculated differently on different types of products? For example, on a mortgage, is interest calculated the same as on a credit card? No, it's not. And is it calculated the same on a line of credit? Certainly not. So let's take these apart a little bit. Let's look at a mortgage. When it comes to mortgages, interest is charged based on the month-end balance. What am I saying? I'm suggesting to you that it really does not matter what happens during the course of the month because the bank calculates interest only on one day, which is the end of that month. So whatever you do, even if you made bi-weekly payments, it does not really affect your mortgage until the end of the month. Let's look at credit cards. When I say the word credit cards, for you, most of you think, well, high interest rates. Well, there is another way to look at it because interest on credit cards is charged based on the number of days from the date of purchase. And for most of us, it's around 25 days. Well, what I'm suggesting to you is this. If you use your credit cards properly, you're actually getting an opportunity to use the bank's money without actually paying any interest on it. Is that a good thing? Certainly, because that's what the bank usually does with your money every day. On lines of credit, interest is charged based on what's called the average daily balance. How does that compare with a mortgage? Very different. In the case of a mortgage, interest is calculated one day of the month. Doesn't make any difference what happens during the course of the month. However, with a line of credit or a credit card, interest is charged based on the average daily balance, meaning it does make a difference what happens during the course of the month. So by varying the balance during the course of the month, you will actually end up varying or lowering the amount of interest that you're actually paying. What's the difference between your checking account and your line of credit? Well, what can you do with your checking account that you cannot do with your line of credit? Very little. In fact, they operate in almost the same fashion. There's one huge difference, and that is whose money is in the checking account? It's yours. And whose money is in the line of credit? It's the bank's. And that can make a dramatic difference once you start to understand it. Let's revise your money flow, shall we? Let's assume that when you get your paycheck, instead of it going into a line of into your checking account, suppose your paycheck went into the line of credit. I'll tell you what will happen. Once it's sitting in the line of credit, even for a day, it's actually soaking up interest that you normally would have to pay on the balance of the line of credit. In other words, the paycheck will lower the line of credit by the amount of the paycheck, causing you to owe less interest on the outstanding balance. And then use your line of credit to pay your bills, pay your mortgages, and so on, and take out available cash for yourself. By doing this maneuver, you'll find month after month, the balance on your line of credit will keep going down. Not only that, when the bank sends you a monthly statement requesting a $300 payment on the line of credit, and you in fact put your entire paycheck in there, which happens to be, say, $3,000, what do you think the bank is assuming? Well, here's a person that pays their bills not only on time, but they pay more than the amount that's required, even if you take it out the next day. This will have the effect of getting the bank to increase your credit limits and possibly lower the interest cost that they're charging you on your lines. Well, we at Fairchoice believe that it is possible to grow your wealth rather than having it sitting there stagnant. We also believe it's possible to grow wealth in a guaranteed fashion and grow it while having some tax advantages. We know that you can enjoy what you've earned and at the same time still leave a meaningful legacy. We know at Fairchoice that it is possible to retire in dignity.